Welcome to the Sweaty Startup. Taking a small detour today, I was invited on a podcast called Acquisitions Anonymous. It's run by Michael Girdley, Bill D'Alessandro, and Mills Snell. Good friends of mine, great entrepreneurs, great follows on Twitter. They have a podcast called Acquisitions Anonymous where they break down a business that's for sale. We talk in this episode about a moving and storage company and also a self-storage facility. I'm cross-posting this. This is something that they recorded for their podcast. I highly recommend you check out Acquisitions Anonymous from those three, but I do think that you'll get a lot out of this conversation. These guys are brilliant and they really ask the right questions, which are right in my wheelhouse of businesses that I have direct experience in. So if you enjoy this, check out Acquisitions Anonymous, follow those folks on Twitter, and here we go.
We are excited today. We got two exciting deals today, both of which are kind of in Nick's wheelhouse. So I think we're going to learn a bit from him about some self-storage and some moving. So we'll let you kind of kick it off. So are we going to kick off with Mills, I guess, first, and then we'll get into Nick's over home plate self-storage deal. So Mills has a moving and storage company out of North Carolina for us.
Yeah. So we have a moving and storage business, quote, with recurring revenue. Asking price is $900,000 on $305,000 in cash flow. Revenue of $1.73 million, $1,730,000. They don't list the EBITDA, they just list cash flow. And inventory of $5,000. The real estate is valued at a little over $1 million and is not included in the asking price. The business has been around for over 25 years. Their reputation in the community is outstanding. Primary customer base of residential homeowners moving to and from the area and just inner city moves. The limited competition exists within their growing market. They use their own fleet of vehicles, and the owner has invested in quality equipment to continue attracting new customer segments. With consistent revenue growth over its history and an established foundation, the business is primed to grow for many years to come. The owner is retiring and wants to responsibly pass the business to new ownership, willing to offer attractive training period with a strong offer. Keep that in mind. Employees have been notified that the business is for sale. The owner would prefer to sell the real estate with the business. So some highlights here are consistent and clean financials. They have recurring revenue elements. Real estate's available for sale, several opportunities for growth. Most business is word of mouth driven. They don't have any customer concentration. Established reputation, not a lot of competition, high barriers to entry for storage and warehousing. The real estate is a standalone facility with warehouse space, staging area, shipping docks, overhead roll-up doors, and office. Comes with an additional 1 acre lot for future expansion. If you're the buyer, you have to demonstrate that you have the ability to actually purchase the land. The business and real estate have been pre-qualified for an SBA loan, $100,000. Let's see. Oh, okay. So they're basically saying there's an SBA loan package, which you could buy the business, the real estate, and get $100,000 in working capital with approximately $315,000 down. So this seller, or let's see if it's a broker. So there's a business broker listed on it. So they've done a little bit of homework for you to say, hey, look, here's a way that you could put the deal together and what you would need. Mid-Street is the name of this broker. They also are a real estate broker and a business broker, which is one of my favorite and least favorite things about dealing with brokers, ones who will do both. All right, that's probably enough of me. Yeah, no, I agree. Let's dive into it. I think this is all repetitive after this.
So this is mostly residential moving as opposed to commercial oriented stuff, it looks like.
Yep.
I agree.
Yeah. Super interesting.
Moving business is tough. It's a freaking tough business. You're dealing with a lot of turnover. You're dealing with rough around the edges individuals who are out moving. I have 17 employees. I'm assuming 2 or 3 in management and the rest are running crews. Mm-hmm. It's tough. I mean, I wouldn't be surprised if the real estate's worth a lot more than $1 million, especially if it's a 15,000 square foot warehouse anywhere near Charlotte or some other major areas of North Carolina. A lot of times you'll find business owners that, subvalue their real estate to sell their business, which is kind of exciting to me. But we tried to start a moving company in Boston with a lot of SEO, a lot of, synergies, some warehouse space. And it was very, very hard to get our start. So I think the barriers to entry are a little higher than what you think. And these folks have a reputation and are getting the first questions I would have is where are they getting their business? Who's sending it to them? Is it coming from online? Is it coming from realtors? Is it coming from, it might be business moves. We don't know. So yeah, I'd want to figure out how they're getting their revenue coming in.
So Nick, I wonder if you could unpack that statement for me a little bit more. Because on one hand, I look at this business and I go, I could start this business tomorrow with a truck and a couple storage units, right? But on the other hand, maybe it's more defensible than I think it is, with a brand, with SEO rank. Is there a moat on an established moving business, or are you just going to be dealing with whack-a-mole competitors coming in to underprice you at subscale, all day, every day?
No, I think there's two different types of movers. I mean, there's high class, pack it up, store it, move it, keep it in their warehouse, and then there's fly-by-night Craigslisters that show up and you don't know if they're sober when they arrive at your house, right? So there's a lot of that going on in the business, and we tried to launch with a very good website, some awesome YouTube videos that we had produced, and a pretty significant budget for it, both AdWords and mailers to people's houses who list their houses on the market. And we got absolutely a whole lot of nothing. And also learning how to move these houses if you're never been on a truck, doing it, packing it up, moving high-end furniture, very tough.
And so how did you crack the code then? If it wasn't, that's what I would have gone to, great SEO, great digital marketing, and try to outcompete digitally for leads. But it sounds like it's not that easy. How did you end up making it work?
We didn't. We shut it down. We tried for 6 months. We invested $40,000 in trying to get some business drummed up, and realized that we had no idea what we were doing when we were trying to get in those houses and pack up nice furniture. And even though we moved 7,500 college students a year, we moved them in and out of their dorms. It's just totally different when you're dealing with nice furniture and houses. So, I mean, I think if you supercharge a company like this, the exciting part for me is adding those aspects, adding the polished website, adding the SEO, adding the digital marketing. And if you have some good crew leaders, I mean, I'd want to get in and talk to the management. I'd want to get in and talk to the person who is running the crews, running the logistics. How long have the movers been there? Sounds like they know that the business is selling. But if you have a decent management team, good trucks, good equipment, I think it could be a hell of a business.
So I talked to a searcher who ended up closing on the deal here in my hometown, and he bought a business like this. First of all, at a much better multiple, but we'll get to that later. But the bread and butter of his business that he bought was actually a lot of recurring and reoccurring commercial customers. And it seems to me this residential space is much more of a red ocean than kind of that commercial stuff. Like, am I just thinking about like the two different types of customer bases different? And are those really the same business, but they just feel different to me? Like, is there a different thing going on there?
High-end customers put their stuff in storage and forget about it, whether it's a storage unit or a moving company warehouse. So I would also want to know, of this 1.7 million in revenue, how much of it is in your warehouse that you hit a credit card every month? Because that is valuable. The turnover is going to be quite sticky, maybe even raise prices and some other things. But yeah, you're absolutely right. If it's almost all service and the warehouse is half empty and you use it to get your trucks prepped, then a much different model.
And y'all keep in mind, we had a previous episode, I'm not sure which number it was, but we had a friend of mine here in South Carolina, Nathan Bocock, he's the largest franchisee for 2 Men in a Truck. So, the other end of the spectrum in terms of size and scale and sophistication from this type of listing. But my brother owns a business that's similar size to this here in Columbia, commercial and residential moving. They have like 8 box trucks, 25 to 30 employees at any given time. They don't specialize in college moving, Nick, but they found a really good niche in decorators. So it's truly kind of recurring or reoccurring in the sense that the decorator rents space in like a really nice area for their showroom, but then they're doing a house, right? That might be a, $1 million home, $2 million home. They need to order 400 packages. And then my brother, as the mover, wants to make sure he gets the move and can charge for, receiving and storage. So he charges a per piece, right? $20 a box, $25 a box, whatever it is to receive it. You can also pay more to have it opened, inspected, and then charges by the cubic foot per month to keep it there. So it's kind of the trifecta,
that is a great business. Great.
It's a great model.
That's the way to go. Yep.
He went from a 4,000 square foot warehouse to a 12,000 square foot warehouse and filled it up in 45 days. Just because people are like, hey, I need to move stuff from point A to point B, but my house isn't going to be ready yet. Do you have somewhere I can put it? And he always just had to refer it out to things like you own, right? No, I'll just move it into your, whatever random storage unit you want. And so now he gets to keep it. He's got a bunch of like vaults, wooden vaults that he can put stuff in and charge by the month. But you're right, getting into this revenue and figuring out what's the delineation between one time versus anything recurring. The other big question I have here is they're saying they have about $300,000 worth of furniture, fixture, and equipment. The condition of those trucks, I mean, it's very capex intensive at a certain point because, you know, you're putting a lot of wear and tear and mileage on these trucks, especially if you're doing interstate moves. And the cash flow might be $300,000, but if you're having to repair, maintain, and replace, you know, a truck a year, you know, you're talking about a pretty substantial haircut to the cash flow.
Mm-hmm. Yeah, they're making $47,000 a day. Where's it coming from? What is it coming from? Moves? How many crews are out, and how much of it's in that warehouse?
Nick, is this a business that has any regulatory impact in certain states? Like, do you have to be licensed as a mover or any of that? Or is this just pure labor arbitrage?
You got to have a workers' compensation is absolutely brutal. So if you're paying an employee $20 an hour, you're really paying $27, $28 an hour after workers' comp and all the other things. So, you know, that's a big regulatory aspect, but you know, you got to be bonded. You got to, you know, we got it done for under 10 grand in Boston. And I'm sure North Carolina is a little bit easier to get, you know, your licensing in order. But I'd say the barriers to entry is just those recurring, where's that recurring revenue coming from? It's really hard to crack. I wasn't able to crack it when we tried to launch.
It does depend on the state. So in South Carolina, movers are regulated because basically the way they get you is you're moving private goods over public roads. And so it becomes a regulated activity. And at least in South Carolina, it's regulated by the Public Service Commission. My brother, when he first got started, he didn't know this. So he was just moving for a family friend. And this guy rolls up with a badge and says, "Hey, show me your paperwork." Basically, my brother's like, "What paperwork?" And he got dinged. And you have to go basically before a board again, this is only in South Carolina, but it probably happens in some other states too. You have to go and basically prove that there's a need for another moving company. And you can go on the Public Commission's website and find a list of every registered mover in the state. So it kind of cuts both ways. You know, it has some advantages to create a barrier of entry, but there's still people who move all the time who aren't actually registered.
In Massachusetts, you had to set your rates. So you had to set public rates and you can't charge. Yeah, bill. Yeah, exactly right. It's a little bit tough.
The 3 times asking price seems high for this. And maybe I'm just jaded by the deals I've seen when people are in this space that they're trading closer to 1 to 1.5 times EBITDA. But I'm curious perspective on that.
Yeah, if that warehouse has 40, 50 grand a month in recurring, that changes it, right? But yeah, if it's all out there on the trucks moving people's stuff, then, you know, 2 times EBITDA is about all I'd be interested in, right?
Yeah. So it sounds like really understanding there's some stuff in here to really dig into that you talked about, but one of those is like really like how much of this is truly recurring revenue stuff versus, you know, hard-earned dollars done via services.
Yeah. Also, you know, we've done a couple equipment rental businesses on the podcast before. This one too, they say they've got $300,000 worth of trucks. I would want to understand, did you buy those trucks for $300,000 and now they're 15 years old? You know, because if in fact the market value of those trucks is $300,000, you know, that you can work that into the valuation. But I have a feeling that the market value of those trucks is substantially lower than $300,000.
Yeah, and what's the debt? And a lot of times you'll have them calculate the equity on the trucks, and even though they have a note for half the payments, right? It can be really tricky. But the tax advantages can be tremendous. I mean, Section 179, all those trucks year one, if you put $300,000 down, you could have a $300,000 tax deduction year one, which is a pretty big deal.
Nick, will you expand on that for 30 seconds for folks who
Yeah, so it's just like bonus depreciation in real estate, meaning like what's the active lifespan of what you buy, and you deduct that expense over the years. So if you assign $300,000 of the purchase price to maybe 7 or 8 trucks, there's a tax code called 179 that allows you to deduct that all in year one over maybe instead of a 5 or 15 year depreciation schedule where you write it off against your taxes every year. So yeah, I mean, if you're in a high tax bracket and you need some write-offs, $300,000 could save you. You could be basically a full year one write-off and you own the business outright.
Yep. And you would get that same 300 maybe over 15 years if it were goodwill. But getting it all up front in year one is obviously significant.
But you go to sell the trucks in 2 years, you got a big income event right then if you fully depreciated them. So that's something else to consider.
That's a great point.
And what we're talking about is this idea of purchase price allocation. So at the end of the day, you know, let's say this business ended up selling for $500,000. you and the seller have to agree, and your attorneys and your CPAs have to all agree on how the purchase price gets allocated across that $500,000. You could say, hey, look, the name is only worth $5 and the trucks are worth 400, and the remainder. But it's basically every advantage you get from a tax perspective is a disadvantage to the seller and vice versa. So it's this point of negotiation that's very nuanced that people don't always talk about, but you can win or lose big time based on how purchase price allocation shakes out.
Mm-hmm. If the owner has only $25,000 of basis left in his trucks or zero, he wants that purchase price allocation of those trucks to be as small as possible, right? So it's a nuance.
What sort of things would you do if you own this business tomorrow to turn it into a home run? It sounds like increase the recurring revenue stuff. What other things come to mind? And maybe adding some structuring to how to buy the business would help as well. Some sort of earnout and that sort of thing.
The 3 to 4 back office staff inside there, I would instantly replace with Filipino call center and admin for, cut 50 to 75% off the labor cost there, and optimize Google My Business location, get a great website built, get some SEO work done, get some videography, and really vet the management and see if you have anybody how are they running their logistics? Because when you got 6 trucks on the road every day, how are they prepping those trucks? How are they how can they be more efficient so that those movers can spend their time moving and everybody else can spend their time doing what they're good at? Because a lot of these moving companies, the movers show up, their trucks aren't ready. They waste your guys who should be out making you money on the road and billing $50 to $100 an hour to the clients. They're in there looking for moving blankets. They're looking for dollies. They're getting things ready. Maybe they're driving to Chipotle every day for lunch, and that's $200 that you could have billed customers because you didn't get them catered lunch in a lunchbox ready to go out the door in the morning. So those are the little things that we did inside of our moving company that just helped us get more efficient.
Yeah. Is there any way that companies like this align the actual movers themselves, the guys in the truck, around the interest of the ownership? I mean, I'm thinking you've seen models where people with plumbers and whatnot are giving people incentives to generate more revenue. Did you guys try anything like that? Or is that something that just ends up with a lot of broken pianos in a business like this?
No, I think speed should be rewarded, and your best crews should be rewarded. So the more hours they can bill in a month, the better, right? So tying it to revenue is great. I think people make a lot of mistakes on trying to tie compensation to profit and all these other crazy metrics that just become a giant cluster and a waste of time and a big mess for everybody. Compensation structures are notoriously way too complex. But yeah, revenue-based bonuses, $100, $200, $500 can mean a big difference at the end of the month for a mover who paycheck to paycheck trying to take their lady out to a dinner that night.
Nick, were you able to I'm trying to remember the timeline of when you owned your moving business and when you started buying storage. Did you run your business remote? Because I'm just thinking, we talk a lot about on the podcast about buyer business fit, which Bill still needs to get some kind of intellectual property protection around that phrase. But if somebody wanted to buy this business, do you have to be an owner operator? Do you have to be in there? I mean, probably right now, the way it's structured, yes. But is it conceivable to run a business like this remotely or passive?
So we were 20. Yeah. It was 2013 or 14. The iPhone had just been become in the pockets of everybody under the age of 30. We were running a pickup and delivery student storage business in Des Moines, Iowa, Bloomington, Indiana, Champaign, Illinois, Ann Arbor, Michigan, Washington, D.C., Boston, Philadelphia, all in the same week. They were all, me and my business partner could only be in one town. We had to have a warehouse rented, the boxes, the moving supplies on site. We had to have the employees hired. We had to have them trained. We had to have them have the right equipment, and we had to have them show up at the right dorm at the right time to pick up the student stuff, or they missed a flight. So you talk about the logistical challenges of what we did in that business. A crew that doesn't move every single day for a year, that's a dream compared to what we did in our business. So we would feel absolutely comfortable running a business like this remotely, but I don't recommend that to somebody without a lot of operational chops and experience, right?
Yep.
I think if there's one thing that my service business did for me, put a little bit of cash in my pocket so that I could go do real estate. It taught me how to be an operator. And I'm so thankful looking back. The money was okay. We got it to where it was generating $200,000 to $500,000 a year, depending on the investments we made that year. But just what it taught us about managing, hiring systems. We cut our teeth on the most logistically challenging business that I can think of. Having college kids drive box trucks in the city of Boston with wealthy, angry parents whose kids are about to get on flights. That's some tough stuff.
Yeah, not a lot of margin for error.
Yeah, I don't love this business now. But it's a great opportunity for somebody who starts out. And there's people who have cracked the code. There's generational wealth generated in these moving businesses. So it's all in how you do it. Just a quick reminder that I do self-storage consulting. If you are looking at your first deal or you want to figure out what to offer on a self-storage facility, visit sweatystartup.com/storage and you can read all about the package that I offer. It's basically, I share a Google folder with you with a model, all of my spreadsheets, my investor packets, the due diligence lists, everything about how I do business. And then you do a lot of homework and we get on a 1-hour call that helps you underwrite and make sure you're making a good investment, basically. And if you're wondering how to find a self-storage facility, which is the most common question that I get, it is getting on broker emails, checking LoopNet, Crexy, listselfstorage.com, and cold calling an owner in your town. Just call them up. I think the best starting point for a self-storage investor is around the $500,000 mark, because buyers like me, we look at $1.5, $2 million and up only. And a lot of retail or multifamily or small town single family rental investors, they don't necessarily look at $5,000 to $10,000 a month of revenue properties, because that's a little bit out of their price range. It might trade from $500,000 to $1 million. So that's the range that you'd look at, and visit sweatystartup.com/storage if you want my help when you're analyzing your deal. Thank you very much.
Cool. All right. That was a good one. Let's move on to Nick's bread and butter, self-storage. So we're going to change it up a little bit. Normally, myself, Michael, or Mills introduces the deal, but we've got a great deal here. It's outside of Charlotte, North Carolina. Being that Nick is our resident expert, we're going to let him introduce the deal and hit the salient high points, and then we'll get right into analyzing it.
So you guys sent me this deal last night. My team underwrote this deal and put an offer in on this deal, right? So I know a lot about this property. And this is the quintessential self-storage facility. Mom and pop operator, 99% occupied, which you don't want to be in self-storage, right? You want to always have a couple of units available or you're not charging enough money. Small, 17,000 square feet was on the listing, but when you dig in and you count for parking and some other things, more like 11 to 12,000 square feet of rentable square feet. So you're not going to have any big players interested in this acquisition, this self-storage facility. You're going to have a lot of mom and pop operators, just like the person who's selling it, who want to buy it and try to optimize it. And while it's a real estate play, self-storage is all about operations and marketing and small business. So this will be a good one to dive into. We have 69 units, 5 miles outside of Charlotte. So a great market, growing town. And it's just what a lot of investors have a lot of appetite for. These small self-storage facilities listed at $950,000. I know for a fact that this went above ask. It went under contract just north of $1 million. And the self-storage market is changing month over month. I mean, 6 months ago, this is a $750,000 property. And now it's a north of 1 million, just because I don't know if I'm tweeting about storage too much, but people, the appetite for this business and the way it's performing is out of this world. So like you have Public Storage and Extra Space Storage releasing year over year, same store growth of north of 15%. They're growing like tech stocks and they have 20% leverage. I mean, the self-storage business is hot right now. So everybody wants in. So
Nick, what are some questions, as you look at a deal like this and you go, all right, I got to quickly decide what makes this a good self-storage facility that's for sale or a bad one? You're like, what makes this a great deal? Something that makes your mouth.
So the first thing I'm going to do is I'm going to dive in and figure out how well it's operated. And I don't necessarily care about revenue management, which is the most important part in my operation model. How much are you optimizing revenue? I want to know if they're collecting rent, because many times you'll buy a self-storage facility from a small owner. Their husband had a heart attack 6 months ago, or they're wealthy and they don't really care, and they're just not collecting rent. Like you'll see a rent roll with $10,000 on it and you buy it and you figure out that they're doing $6,000 a month and the rest of them need to be auctioned off and you got 40% vacancy, right? So I'm looking at that, and then I'm going to do a competition analysis. And I actually did a competition analysis on this deal, and we have some REITs in the area, which is good and bad, because when there's REITs in the area, I know what the true market rate is for self-storage in that area. I like buying properties where there's no REITs in the area because only I know what the market rate is, because I have data, because I've bought 25 self-storage facilities. I know that, they're charging $63 for this 10 by 10, but everybody in town is full. So I know the true market value is north of $100 for a 10 by 10. So I can underwrite that and judge on that. They're charging at this target facility, they're charging $74 for a 10 by 10. Storage Rentals of America, a REIT, $129 for a 10 by 10. Extra Space Storage, $131 for a 10 by 10. Then you got a couple mom and pops charging $65 and $60. So that's drastic. That is a drastic difference in potential revenue when you're looking at a self-storage facility. So I'm figuring out right away, what's the revenue they're doing right now. In my back of the envelope math, when I'm underwriting a self-storage facility, if I can buy it at 100 times monthly revenue that they're achieving, that's actually going in the bank. I'm not talking about rent rolls, what the owner says they could potentially do if every unit's rented at 100%. I'm saying, what is the amount of money that you're putting in the bank? On this deal, it was $8,300 a month. So buying it back of the envelope math for $830,000 means I'm going to hit okay cash on cash returns, and I know it's going to be good. But yeah, I'm trying to figure out A, how much can I raise rent, and B, what's going to happen when I raise that rent. So I underwrote this thing where we're going straight up to the REITs. We're going north of $100 for a 10 by 10, and we have massive tenant churn on day one. You send that letter out to those tenants and say, hey, I know your rent's $73, but we're going up to $129 because it's market. I'm really sorry. Half of them are going to leave. We always underwrite that about half of them are going to leave. In reality, it's about 10% because they all huff and puff, and then they realize there's nowhere else to go. It's true market rent. So I got to underwrite. When I'm trying to underwrite and figure out how much this business is worth, I'm trying to figure out how much is that work that I'm about to do worth. How much I'm about to have to buy this storage facility and take everybody from $73 up to $129. I'm taking a massive amount of risk when I do that. So what's going to happen? In this deal, I underwrote losing 45 of the 105 rentals. So 45 customers would move out when I raised the rents that much. And now I'm stuck at 61% occupancy and I got to lease up. I buy it right before winter. I know nothing happens in January. I know nothing happens in February. So March, April, May, June, I'm going to lease up next year, get back to 96, 95% by July or August of next year. And that's when I'm finally making the money. And I'm doing about 11 to 12,000 according to my underwriting a month. So I'm taking a facility from 8,300 a month to 12,500, 12,800, and then trying to figure out what my returns are. And when I look at my overall cap rate, which is like an unlevered yield, if I spend $1 million, what percentage of that am I going to get back in cash flow every single year? 5.4% year one if I pay over $1 million, which is what this thing went under contract for. 10% year two, which puts my cash on cash well north of 10%. But again, I've done a lot of work. I've taken a lot of risk. Probably not worth it for me. I'm out.
Okay.
Nick,
So in this case, you think, you kind of at first your 1,000 times monthly rent. You said it was
100. Yeah, 100.
100 times. So that means it's worth $830,000 by roughly your back of the envelope math on day one. You think you take it to $1,200 or $12,000 a month, that makes it worth $1.2 million. If after you do all your changes, et cetera. Their asking price on this thing is $900K. So kind of smack
950. Yep.
950, smack in the middle. So does that mean you feel like this thing was fairly priced, underpriced? How do you think about that?
Yeah, so I think it all depends on the person, the nuance. This is where real estate is so individual specific. If you are a new investor, you only have 100 or 200 grand to deploy into real estate and you're trying to raise some family money and you get to do one deal in the next 6 months, then this is not the deal for you because, it's average, right? You're buying it at an appreciated value already. You're going to add maybe 200 grand worth of value. After you have the transaction costs, you could sell it on that day and break about even, right? It's not that sexy. But if you have $2 to $3 million in the bank and you need to buy a bunch of storage, this is a low risk deal for you because capital, being well capitalized in storage in real estate is what keeps you out of trouble. So if you have cash on the sidelines, you can take the risk of doing some work year one and not having any yield year one to have some upside down the road. Yep. And then you got to think about growth outside of Charlotte, right? Over the course of 3 or 4 years, you might be able to drive revenue another 30%. I don't like to underwrite that stuff because it's pure speculation, but a lot of tailwinds in storage outside of Charlotte. So, somebody buys this, they know what they're doing operationally. I would not be surprised in the least if 3 years from now, it's worth $2 million.
Interesting. So it's definitely a bet on the area and self-storage as well, the market.
How in a self-storage deal like this, do you anticipate the potential for new entrants coming into the market nearby, right? At least where I live in San Antonio, like even in the infill areas, people are still building self-storage. So like, how does that fit into kind of future modeling of a deal like this?
Big time. So that's one of the reasons why I like to do business up in New York and Pennsylvania, because if I pull up my portfolio statistics here, I'll give you some accurate numbers on what we've been able to do from a going in cost basis per square foot. I look at price per square foot. This listing is at nearly $100 per square foot because when we dug into this, it said 1,700 square feet. It was actually only 11,000 square feet. I know that it's near $100, $95 a square foot is what this is going to take to buy this property. I know I can build storage for 50. So that's going to attract developers. Developers are going to come in, they're going to build it. But then there's the different levels of an institutional class A 3-story climate controlled building that does cost $100 a square foot to build. And as actually we're learning a pain in the ass for customers to take their shit up to the 3rd level of a self-storage facility. And these drive up units that maybe this owner spent $10 or $11 to build 10 years ago. Now they're selling it for 100. They're going to make a good profit, but land is what you can't get a hold of around there. So outside of Charlotte, land is going to cost you $600,000-$700,000 an acre if it's got some traffic. So I'm not as worried about development of drive up self-storage in this market right here at $100 cost basis. And it's all about the cost basis. I mean, REITs get cheaper debt, so they need less returns. So maybe they can charge the same as you at, they spend $150 a square foot to get into a market. But there's just nuance around that. And in my portfolio, average cost basis we've deployed $37 million over the past 12 months. $55 a square foot is our average cost basis, which is about replacement cost. Meaning we've bought full self-storage facilities that cash flow on day one about replacement cost. The market's changing. We have 250,000 square feet under contract, actually 387,000 square feet under contract right now at $73 a square foot basis. So, there's a lot of nuance around it. But yeah, if you can sell full storage at $200 a square foot, the developers are going to run wild.
Nick, you mentioned the term REIT, real estate investment trust, a few times. Will you talk about what their prevalence in the market looks like? And my understanding is there's pros and cons, right? They'll gobble up new construction. They help set pricing, but can you talk about some of that?
The average Joe does not operate in the same asset class as the REITs, in my opinion. A REIT is life storage, public storage, extra space storage. They buy 50,000 square feet and up, so 5 times larger than this, and they put a manager in every single unit at every single property. They have an office, they sell boxes, they do all this other stuff. They build the 3-story properties that you see going up everywhere outside and in all these towns. That is Class A REITs that operate those properties. I do business with drive-up row facilities, remote managed, smaller, which I consider myself a totally different asset class than the REITs.
So basically, you have this publicly traded entity that has much lower cost of capital and much lower hurdle rates, and they're able to say, hey, look, to their investors, look, we have a 8% dividend yield or whatever it is, right? Very high.
Yeah, so I'll give you some details. They pay a 3.5% dividend. They're about 20% levered. And when you have a $3 billion portfolio and it's only 20% levered, that debt they get at, sub 2% debt, interest only forever, right? So their cost of capital is so low and they're promising a 3.5% dividend to their investors, they can buy 4 caps, 3 caps all day long and still make money. It fits in their model. Whereas you and I, we borrow from a local bank. We're borrowing it for 3.5%. We don't get interest only. So our debt constant, our total cost of debt's near 7%. We have to buy 6, 7 caps to make our numbers work because we're on a much smaller scale.
Yep. Can you talk about, you've alluded to it in some ways, but A, B, and C class property, I have a frame of reference for that in like office or industrial, but for storage, class A is like you're saying, maybe multi-story, climate controlled with elevators, with on-site staff, on-site store for shipping materials. Where does this property that we're talking about fit? I think it was listed as Class C, but help us understand the delineation between those. Is it like, keyless access? Like, how do you think about the different classes?
Yeah, I think there's Class A, that's the new climate-controlled multi-story buildings in and near metros. There's Class B, which is larger 50,000 square foot drive-up facilities that are large enough to support a manager, but too small or, not climate controlled, maybe built 10 years ago, or just no climate controlled. Class C and D is kind of a blurred line of everything else, which is small, under 20,000 square feet, things like that.
Okay. On a property like this, like, would it have remote access in terms of people drive up, they type in a code and the gate opens for them, but then all the locks are actual physical locks, like padlocks?
Yeah, so operational advantage, that's a big part of analyzing this deal. If an outside investor was looking at this deal, it has a current management company in place. You have to vet that management company. You have to figure out how they do business. I know that they don't do business well enough because they're 100% full. They charge $74 for a 10 by 10 instead of $129, right? So I would get them out right away and I would manage this property and I would raise rents. I would do marketing. I would do some things that the REITs do, manage it well. But no, you use a software, and the software, you pull up to the gate and there's a sign on the gate that says, go to this website to rent a unit. There's nobody there. You go there, you sign the lease, you pay on your phone, you get a text. This is how it works at all of my properties. You get a text message that says, okay, your unit number is this and your gate code is this. Punch it in and watch this little video. They click on their phone and watch a little video that shows somebody punching in a gate code and going right to their unit. They open their unit and there's a normal physical disc lock on the floor. They use it to put on their unit. You don't need nearly as much technology as you think to remotely operate these properties.
And is that an off-the-shelf software? I mean, you didn't build that, right, for yourself. There's software providers that, yep.
Mm-hmm. I'm a big fan of using what's already there. And I think we built some software for our small business back in 2012, 13. Software quickly becomes a massive liability that you have to maintain. Apps, everything's changing. I'm not a fan, right? I want somebody else to do that maintenance, and I want to pay them $150 a month.
Yeah.
Yep.
If you need a guy in the field, right? Like let's say something happens, right? And somebody has to go out to the property. You just source a person in every market who can go cut a lock, go repair something that got dinged or whatever.
Yeah, at my company, we have a team of folks, one American, one Colombian, and one Filipino that work in the maintenance division, which is keep every property clean and well maintained. And when somebody moves out of a unit, get a new lock in there, sweep it out, make sure it's ready for a new customer. And that involves 6 or 7 vendors at every location. You need a lawn care, you need snow removal, you need a cleaning company to come in, open the unit, sweep it out, do the checklist, overhead door, a locksmith is outsourced. So if a customer has a problem with their lock, they step on it, they break the key off in it, whatever it is. If our customer service rep can tell them to go to a little box on site to get a new lock, if that's how it works. But if it's stuck on the unit, they got to call a locksmith. You just build systems with vendors for all this stuff.
Yep.
What you said about software reminded me of one of the great pieces of business advice I got that I try to keep in my mind, which is for every area of your business, ask yourself, can I compound this area faster in my business, or can someone else, can an outside vendor? And in the case of software, it's like the classic example of that software vendor, whoever you pay $100 a month, they've got a team of engineers. It's all they think about. They're making that software better every day, day in and day out. They're compounding that area of your business. Every time they release a new feature, you get it. There is absolutely no way you could outbuild them because you're trying to run self-storage. So I think it's a perfect example of for everything. I mean, even if you're an e-commerce business, ask yourself, can I compound fulfillment faster than Amazon FBA? Probably not.
Yeah, there's been 50,000 hours put into my software. Am I in the software business? No. Why would I try to replace a team of 50 folks out in Provo, Utah, who built this software? Why? I'm not in the software business. I'm in the real estate business.
Yeah. So you want to rent that software and own the real estate rather than own the software.
If you try to do innovative entrepreneurship, what we did in our pickup and delivery student storage business, there was no off the shelf software for what we did. It was a little bit different. It's another reason why I don't like innovative entrepreneurship.
Nick,
operational,
really quick,
excellent entrepreneurship.
When you're buying a property like this, you've obviously got a lot of reps on this. If somebody's doing this for the first time, what should they expect in terms of loan to value and actually financing the transaction? And as you've kind of been in the path of progress, right, and gotten momentum, how have your terms and underwriting and covenants of the lending that you're getting, how have they changed?
Yeah, so I think as I build a real estate private equity company, what I look for and how my business works is different. We have AUM fees, we have management fees, we have, different overhead that it takes to run a property. So under 15 or 20,000 square feet is very rarely worth it for me now. A starter, and we get, 60 to 70% LTV, we're putting in more equity. Our average deal is 2.5 million. Whereas a starter, some of our deals, Danny and I did way back in the day, 2019, I say way back in the day, less than 2 years ago, right? We were literally acquiring $450 to $1 million properties. And that's where a lot of value is, because anybody at any scale like me, too small for me, right? But in the REITs, obviously way too small for them. So you're competing with a very limited pool of buyers who have $100,000, $200,000, $300,000, $400,000 cash to buy a $1 million property. You're generally going to have 30% that you need to put down in cash, plus closing costs, plus $20,000 in an operational account. Very, very capital intensive business. So if you don't have any cash, this is not for you, because the smallest viable self-storage facility is going to be $500,000. And you're going to need $200,000 to close, and you're going to need another $100,000 in reserves. So if you don't have $300,000, then this is not the business for you. So, but there's a lot of value in those. If you don't have a management fee, if you're going to answer the phone, if you're going to go sweep the units, you can operate some of these things for $1,000 a month, and they generate 6, 7, 8. So it can be very, very lucrative for a small proprietor.
What else should we know? What haven't we hit on the self-storage deal?
It's a really tough business right now to find deals because the amount of capital chasing self-storage is intense. So our entire bottleneck is with acquisitions. I spend 75% of my energy as a CEO of our company trying to find deals, trying to build systems to find deals. I'm working with 3 full-time acquisitions folks who are the highest paid people in our company who cold call owners, right? So once we buy this thing, it's blocking and tackling. It's not easy. The operations is never easy, but it's making sure you have a clean property and making sure you answer the phones. The hard part is finding the deals, because self-storage, while it's a great business, if you overpay for it, it's not a great business, right?
So what's interesting is I think a lot of people go looking for self-storage and they kind of put it in this class of sort of like value-added real estate, where it's like real estate plus, right? So they're very tempted to go, oh, this is a passive investment, right? I can buy a self-storage, I'll put in all the software as you described earlier, and then I'll just sit back and collect the mailbox money. But it sounds like that's the trap of self-storage, and that this is not passive real estate. This is a business.
We buy facilities from people who bought them 5 or 6 years ago, thinking that it was a passive investment and hiring a low budget management company to not drive rents for them. And imagine if you paid $5 million, but I'll tell you what would happen. If you paid the $1 million for this property and you did not raise rents, your cash on cash would be 3%.
Not worth it.
So if you don't know how to manage, if you do not, and how would you know that you can raise rents $50 a unit? People would laugh at you, right? You'd be like, are you really going to raise rents $50? You're crazy. If you don't know this business and you don't understand how the models work, it's really, really hard to compete right now as a buyer. So it's tough.
Makes a lot of sense.
It makes me think Brent Beshore has this saying that he used to use a lot of, I don't like to compete with doctors. So like in looking at deals, right, we don't want to bid against somebody who just has more money than they have maybe sense or expertise, right, on a specific asset class.
God, that is so applicable to what we do. That is so applicable to what we do.
I agree. I don't want to compete with doctors, but I don't mind being on the other side of the trade from a doctor, right? I had a friend who bought an asset that a dentist was like, oh, I could totally buy this thing and run it passively. And then a year later was like, this is the most non-passive thing. I can't run my dental practice and this business. And then got out for 1x EBITDA, you know?
A lot of wealthy doctors and lawyers hire me to consult on a self-storage deal that they're looking at. And I get on the call with them and I talk about the operations and I talk about the nuance. And by the end of the call, they're like, what the hell am I doing? This is not the business for me.
Yeah.
Yeah, I think so many people are out there. I mean, I even see it in tangentially to my business, e-commerce. The FBA roll-ups are so hot, right? And so people think, oh, Amazon does all the fulfillment, all the customer service. You know, I just like bring it in from China, send it straight to Amazon, and I don't even think about it. It's passive, and it's the same thing. Doctor or equivalent, somebody comes in, they pay 5 times EBITDA for this business, and they go, oh, it's 20%. Unlevered cash on cash yield, right?
I can't lose money. I can't lose money on it.
And then, I see it a year later, the business is down 50% and they're losing money and it's a complete disaster.
I'll say that I don't want to scare people off from this too much. We don't have toilets, we don't have carpet, we don't have appliances, we don't have boilers. I mean, once you acquire an asset and if you acquire it right, it really is very, very simple to operate a self-storage facility. It's a steel box. At some of our small 11,000 square foot properties, we get 3 phone calls a week. 3 phone calls a week, and we send out somebody every 2 weeks to do about a 2-hour checklist. So, if somebody wants to get in self-storage, I would say have a little bit of operational chops and call around to in your local town and talk to these owners. And if you can find a decent deal at 100 times monthly revenue that they're doing right now, it's worth looking into more and maybe getting some consulting or diving into the deal.
Totally. But the funny thing is, aren't there 2 types of people? There's 2 types of people who go, oh, 3 phone calls a week, that's nothing. That's great. That's passive. And then there's another type of people who go, 3 phone calls a week, that's way too much, right? Like, I don't want to think about this at all. So you gotta decide what type of person you are.
Bill, that is a very interesting concept because I think the level of stress that we dealt with in our first business, where we had employees driving on Starro Drive in Boston where trucks are not allowed and ripping the whole top off our truck, that was stress, right? A warehouse maybe floods, part of it floods, and you have a real problem. Some people really get stressed about small things that are not stressful to folks who have dealt with real stress.
Yep, that's fair. So it feels
stress is a relative term.
Very passive if you're an ex-entrepreneur. It probably feels pretty active if you're a REIT investor.
Very well said. Very well said.
Yeah. Cool. Well, that was awesome, Nick. Thank you. We've loved having you. I'd love to give you just kind of, where can people find you, follow you on the internet, find you and learn more.
Yeah. So I have a lot of stuff. I have the Nick Huber Show, which is a real estate focused short form podcast, about 10 to 15 minutes of me talking about things I'm learning as I build a real estate private equity company, a lot of self-storage. I have a real estate community that's paid. I have a blog, Sweaty Startup. I have a small business podcast called The Sweaty Startup, and I do self-storage consulting. If you want to DM me on Twitter, which is at Sweaty Startup, and you can email me as well, nick@sweatystartup.com. I put myself out there a lot, so I think it's pretty easy to find me, but I do a lot of stuff.
You have more than 24 hours in your day, Nick? Just asking, because if there's a way to do that, I would love to.
I'm all about super efficiency. So like you guys, one take, send it to my editor, get it up. You can accomplish a hell of a lot if you're really efficient. And I'm the kind of guy where I'll get it 80% of the way there with 20% of the effort and ship it, right? I'm not going to try to make things perfect.
Love it.
Yep. I love that. I love that.
And I spend almost all my time recruiting and hiring right now. It's a lot of my focus. So my job as a leader is not to tinker in the business. My job is to find people and place them that can really help me grow and scale. So just 4 months ago, I hired a CFO that is just blowing me away. And I'm so excited about that. So he's doing my job better than I was at the real estate private equity company, which is liberating and exciting as we grow and scale. So I still do have some time to hang out with my family and friends and play a little golf.
Yeah, it really does become all people and strategy and systems once you hit some scale.
I wish I could have asked you all more questions about your experience, because I hate that I come on these things and it's all about me when I'm the fourth smartest person in the call here.
Boy, we got you fooled.
Cool. Well, that'll wrap it up for today. Thanks for coming, Nick. It was awesome to see you. This was a really fun discussion, and we'll have this posted soon.
Hey, disclaimer, I'm just a guy, just have one way of doing things, and I'm learning every single day. You talk to me 6 months, I may disagree with a lot of what I say here, so don't take it as fact, right?
That's right.
Right on.
We're all just people.
Right on.
This episode of The Sweaty Startup is brought to you by Jobber. And Jobber is a software that allows service business owners to run the back end of their business with ease. You can get quote request forms right inside the app on your website from customers. You can send out quotes to customers with a couple clicks of a button. You can set up all of your automatic email templates. You can send bills. You can get paid. You can stay organized. You can even schedule your employees. Now, GetJobber is unbelievable, and my brother uses it to basically run his lawn care company without any admin work. And I just highly recommend this service. Visit getjobber.com/sweaty for a 20% discount and a free trial. I think if you run a service business, it is the best way to appear professional to the customers and also be incredibly efficient on your end. Now, one more time, it's getjobber.com/sweaty.